Now, let's get the stock impact of GST developments with Gurmeet Chadha, Managing Partner, CIO, Complete Circle. We'll also connect with Jyoti Gupta, Research Analyst at Nirmal Institutional Equities. Gurmeet, good morning. Always a pleasure speaking with you. What do you think have been the highlights out here? I mean, I was looking at some of the hotel business because, 7,500 rupees from 12% turns to 5%, but it's the with and without input tax credit that makes a bit of a difference. Of everything that Timsy suggested could be on everyone's mind, what are some of the standout features for you?
Yeah, hi, Mangam. Good morning. Always a pleasure. I think, some of the measures are obviously welcome. See, the private final consumption accounts for 60% of the GDP. So any boost in consumption along with income tax cuts which have come in, as well as the welfare benefits government has done in the rural part especially, will augur well. But I just hope that there are not too many, rejig rather than final cuts. So eventually you want more money in the hands of consumer and not too much of a rejig just to compensate, moving items from, let's say, 28 to 18 and or 12 to 5, and then, So I don't want to see too many things in the 40% slab. Because that will then dampen the spirit, because luxury consumption is something which has also been a contributor at the margin. I think cement clearly looks to be a winner. I also think two-wheelers clearly and smaller cars seem to be a winner. I think paper, textiles, especially apparel, less than. I think there's a price threshold getting increased to 2,500. So, your retailers will gain. I think what could probably be a bit of a dampener could be more things in the 40% slab. So that's what I want to do. Hotel, I think, is travel and hotel has been one of the top themes as far as consumption is concerned. We have lemon tree in the portfolio. There's been very sharp movement in the stock in anticipation of what is going to come. So as far as 5% slab comes without ITC, I think it's fine. I think more importantly, Mangalam, from a broader consumption theme, the inverted duty structure needs a look. See, there are a lot of classification disputes also in GST. If you meet any GST tax consultants, they'll tell you. Second, because of the inverted duty structure, again, there are a lot of host issues. So you want input and output, taxes to be aligned so that broader benefits gets passed on.
Got that. Gurmeet, good morning. And Jyoti, good morning to you as well. We'll do, let's take sector by sector, right? And Jyoti, thanks for joining us. For cement, right, what we're picking up is that the centre is proposing that the GST rate be cut from 28 to 18%. What does it mean for companies? What does it mean for stocks that you cover, Jyoti?
Hi, thank you so much for having me on the show. So there are two parts to it. While currently, if you see, the demand is anyways muted, it's anyways going to pick up over the quarters. It's a seasonal impact. But when it comes to GST, there are two parts to GST. When you're reducing it from 20 to 80, it will have some impact on the operating incomes of the company, and that could be offset by increase in demand in the later part of the year, maybe next year. But if you ask me positive, yes, you could have extra money in the hands of the consumers, but that does it mean immediate, coming back into the economy in terms of cement consumption? Maybe, but with a lag. But not
right. Jyoti, have you done any sensitivity analysis on if, say, prices were lower by 5%, how much do volumes increase by? Prices were lower by 8%, how much do volumes increase by? And the other side, because if the GST is coming down from 28% to 18%, one would impact a price rationalization of at least 3 to 4%, right?
Actually, this kind of sensitivity is possible only if you have a consistent demand. That's where you see, that, if the demand goes down, if the prices goes down by 5 rupees, then possibly the demand would increase by 2%. But, in India, cement is, it doesn't follow that kind of trend. And if you are reducing the GST, and in a scenario where demand for a full year is expected to be around 6 to 7% and not around 9 to 10%, I think what I'm going to see is, anyways, South has already seen a rollback of almost like 15 to 20 rupees, while the rest of regions are already a reduction of 3 to 4 rupees. But that's an ongoing basis. It's part of the industry. So, in fact, the industry has already taken an increase in prices in the South region by 20 to 30, and that should eventually get absorbed in the quarter.
So short point is that this news by itself does not make you tweak your estimates or your model.
Absolutely not, because I've already taken in a very base case scenario. Even if that happens, it's not going to spike the demand. I don't see 7% or 6% going to 10%. Even if it happens, maybe it could happen with a lag, and possibly you may see an impact in FY27. But if you ask me in terms of the impact of GST on the operating income, yes, the companies which have just recently commissioned and plants in 1 to 2 years, last 1 or 2 years, and likely to have, they will possibly see some impact within their from the GST.
In terms of cost workings, etc. Got that. Jyoti, just coming back to you, Gurmeet, autos, because that's where the focus is, right? Has been from a market point of view as well. Stocks, by the way, have done well. If you just look at this series that just expired yesterday. Small cars, 28% to 18%, right?
Yep.
Then the other bit is for luxury cars, which is greater than 1200 cc, there is a hike to 40, but GST is already 40. There is plus a cess. So the logical assumption is that the rate will be 40 and the cess will be subsumed. Because right now, effective rate is up north of 55%. If that is the case, if cess is subsumed and the rate is 40, and since the market has moved to these larger cars, 1200 cc plus, do you think it'll be it'll give a big fillip? And by the way, for parts, seats, accessories, and these graphics will come up. The proposal is to cut from 28 to 18%. So just run us through the three segments and what you would do from a stock point of view. Small cars, luxury cars, and auto components.
Sure, Prashant. So I don't think so, the effective price. I think effectively the price would be slightly lesser or same as far as the above 1200 cc is concerned. I'm not too sure on the extreme luxury end, which could be, let's say above a certain price threshold, and not just the engine, like, the Beamer and the Mercs of the world. So starting from the lower end, so for example, two-wheelers, I think, are a big beneficiary. I think and that's coupled with good rural demand. We're already seeing month on month two-wheeler numbers being better than, four-wheelers. So and there is some valuation comfort. May not be as much in TVS because TVS has got re-rated over a period of time. But even in a Bajaj Auto, it's sub 9,000. Hero also, despite the run-up, you're getting it at, mid-teens in terms of valuation. So any pickup there with good festive demand coming, price reduction, something in the hand, lower rates, all of that combines well. Ancillaries will benefit. We've already seen Uno Minda made a new high yesterday. 40-45% of the product mix is towards two-wheelers. We saw Lumax made a new high at 4,300. Then there are companies like Sandhar Technologies, which have a larger two-wheeler portfolio. They make frames for the bike. They make locks. They are now coming up with the fabrication products as well. So you got to map the value chain there. I think the two-wheelers and tractors, to me, tractors again, I think it may move down from maybe effective rate can move down. It's already, I think, at 18. It can come down to 5. So I think 12, if I'm not wrong. So that's another one we want to look at, especially the farm equipments as well. Four-wheelers, I think, barring Maruti, we'll have to see. As I said, we'll have to see. It's not negative. My sense is it will be positive, and cess would be removed. Only the effective rate would be less than what the final rate is today. So M&M, I think, remains a top pick. I also think now M&M is the second largest player, Prashant. Now it's above of Hyundai, and I'm doing a lot of. One of my clients is one of the largest dealers for M&M in North. I think despite this rates announcements, one segment, one car maker where the demand is still holding up better than others is M&M. So SUVs, I think they're at 27% market share.
Yeah, and there's still more positive calls coming in. We had one from Chris Wood of Jefferies just today. They've added M&M to the portfolio, making some changes. So even at these levels, there are people showing the thumbs up on M&M. Got that point. Gurmeet, on consumer, what would the what should the approach be from a stock perspective? Because I was reading on a whole host of a lot of things, including, for instance, toothpaste, talcum powder, hair oil, shampoo, dental floss, soap. All of it is moving from 18% to 5% if these proposals go through. On the flip side, you have caffeinated beverages, carbonated beverages containing fruit juice, etc. They could be moving up to the 40%, sin level. So purely from a consumer standpoint, then of course there are durables, consumer durables, ACs, etc., where again it could be cut from 28% to 18%. Now, how much is left in terms of the stock play? If you look at the last 1 month, for instance, a stock like Blue Star is up 8%, Trent is up 4%, but a lot of others haven't moved at all. So purely from a consumer stocks perspective, what would you buy? And if there is something that you perhaps really need to avoid now, I don't know, if Varun Beverages has an overhang now, for instance, if this goes to 40%.
I think so we need to divide it between core and tactical. I think tactical, some of it could be FMCG. We've seen some run up in HUL after some decent numbers, right? And stock hasn't done anything for 3 years. Nestle, again, because the food portion is higher. You have to also see where the packaged food could benefit, right? Within FMCG, you have to also break it down. So something like a Nestle, like a Tata Consumer, which has less carbonated drinks, more beverages. Something like even a BKG, where probably the food portion would be 65-70% maybe. So that could come under a more core portfolio with enhanced demand. Similarly, something like Trent, where the price point is not more than $9.99. Stock has corrected from 8,000 odd levels to 5,000. Still expensive, but growing. You get that 25-30% growth. Market needs to see growth in this kind of environment. So that could be there in the portfolio. I think hotels, travel platforms as well. And something like an internal, Swiggy, Nykas of the world. So I think you play that in terms of core, new age, traditional, and then there's a structural demand coming. Tactical could be, some of the names which haven't done well in FMCG, where I don't see 10% volume growth coming back. You can have a Lever, you can have a Daburs of the world, and play tactically. And then, once you've made enough money, maybe move out of it.
So to sum it up, Gurmeet, the best way to play these upcoming GST cuts, you would say some auto names like M&M. Leave us with your top 3-4 names.
So, I think two-wheelers, Bajaj Auto and TVS and Uno Minda in terms of ancillary. You can take M&M and in four-wheelers, maybe a bit of Maruti. Again, hasn't done much if you see last 6-7 years. Platform play, Eternal, Swiggy and Nykas of the world. And I also think Jio Finance, some of the NBFCs will come part of this as a broader consumption play. And travel. Any further price correction in Indigos of the world is again welcome.
Very useful, very, very useful, Gurmeet. Thank you for joining us early morning and appreciate you being with us. Jyoti, thank you very much with that very sharp view on cement as well. So thanks, both of you, for being here.